Facing redundancy can be stressful, but in the NHS, redundancy pay is designed to help you leave in style, with a financial cushion and options for your pension. In this video, I'll explain exactly what counts as NHS redundancy, how pay is calculated, what it means for your NHS pension, and key tax rules and traps to watch out for, whether you're an Agenda for Change employee or on an equivalent contract. Understanding redundancy pay means you can plan ahead and maybe even turn redundancy into an opportunity. With that being said, sit back, relax, and let's take a deeper dive into the data. So first up, what is redundancy? And how does it actually apply in the NHS? Redundancy means your job is no longer needed due to organisational change, restructuring, service closures, or funding cuts. It's different from being dismissed for performance or misconduct. For example, if your department is closed or merged, your role might be made redundant. But if you're dismissed due to disciplinary reasons, that's not redundancy. In simple terms, redundancy is a collective term for involuntary job loss caused by genuine workforce changes. However, not all departures are redundancies. Voluntary resignations, retirement, or contract terminations that aren't linked to organisational change don't count. It's important to distinguish redundancy from dismissal because only redundancy entitles you to redundancy pay. Your NHS redundancy pay depends heavily on your continuous service, including any service across multiple NHS employers, as long as breaks are within allowed limits, usually up to 1 week. This continuity is key for calculating your entitlement accurately. Most NHS staff fall under Agenda for Change terms and conditions, which have clear, nationally agreed redundancy pay scales. Some staff, such as doctors and dentists, have different contractual arrangements, so redundancy pay isn't usually calculated in the same way. It instead follows other national or local agreements. This may include more or less generous pay and different notice periods, so always check your specific contract. So how is redundancy pay calculated? Firstly, it's important to distinguish between the two types of pay: statutory redundancy pay and contractual redundancy pay, commonly referred to as NHS redundancy pay. You will either get one or the other, or you may not get either if you are ineligible. Statutory redundancy pay is the legal minimum set by the government, and you're normally entitled if you're a UK employee and have been working for your current employer for 2 years or more before being made redundant. However, you're not entitled to statutory pay if your employer offers to keep you on, or your employer offers you suitable alternative work, which you refuse without good reason. There are also some additional staff categories that don't qualify, but these aren't applicable for this video. Importantly, you have 6 months from the date your job ends to apply for statutory redundancy pay. You'll normally be entitled to half a week's pay for each full year you worked under 22 years old, a week's pay for each full year between 22 and 41, and then 1.5 weeks' pay for each full year, including and above the age of 41. Length of service is capped at 20 years, and your weekly pay is the average you earned per week over the 12 weeks before the day you got your redundancy notice. There are some caps in place depending on when you were made redundant, so it's worth checking the government website for further clarity. If you were made redundant on or after April 6, 2025, your weekly pay is capped at £719, and the maximum statutory redundancy pay you can get is £21,570. You can also claim statutory redundancy pay if you're eligible and you've been temporarily laid off, without pay or less than half a week's pay, for either more than 4 weeks in a row or more than 6 non-consecutive weeks in a 13-week period. Now remember that statutory redundancy is the lower limit for pay, so if you are already getting more than this through a contractual scheme, then this is not really relevant. Now the other type of pay is your contractual redundancy pay, which we will look at now, specifically for Agenda for Change staff. First thing to note is the difference between continuous service and reckonable service. Continuous service is what's used to check if you're eligible for redundancy pay, providing you have 2 years service with no breaks longer than 1 statutory week, while working under a contract of employment for an NHS employer. Reckonable service is used to calculate how many years actually count for pay. This essentially means the period of continuous employment by NHS organisations, with no more than 12 months between jobs. There are some additional stipulations which I'll show on screen now. These years can all be counted unless already used in a previous redundancy or Mars payment. NHS Redundancy Pay is very generous and is calculated using 1 month's pay for each complete year of reckonable service, with a maximum of 24 years service being counted. Fractions of a year are not taken into account. The monthly pay figure used is the amount equal to 1/12 of the annual salary at the date of termination, or 4.35 times a week's pay, whichever is more beneficial to the employee. For those earning less than £23,000 per year, full-time equivalent, the redundancy payment will be calculated using notional full-time annual earnings of £23,000, prorated for employees working less than full-time. For those earning over £80,000 per year, full-time equivalent, the redundancy payment will be calculated using notional full-time annual earnings of £80,000, prorated for employees working less than full-time. This means no redundancy payment can exceed £160,000. You must submit your claim within 6 months of the date your NHS employment ends. Redundancy pay can come with some tax and financial pitfalls you need to be aware of. Firstly, the first £30,000 of redundancy payments is tax-free, but only if it's a genuine redundancy payment. Many staff receive payments including pay in lieu of notice, accrued holiday pay, and other contractual entitlements alongside redundancy pay, and these parts may be taxed under pay as you earn. It's essential to understand the difference, because misclassification can result in unexpected tax bills. Another trap is the impact on student loan repayments. Large lump sums from redundancy can push you over repayment thresholds in the tax year, triggering higher deductions. Similarly, if you claim means-tested benefits, redundancy payments can affect your eligibility. Timing is important. Redundancy payments received across tax years might change your tax liabilities. For example, leaving at the end of March versus early April could mean the difference between paying higher or lower tax. Because of these complexities, getting professional financial advice is highly recommended before accepting redundancy packages. So let's now look at an example to clear things up a bit. A nurse is made redundant due to workforce restructuring. Aged 55, they have 15 years of continuous service under Agenda for Change, and their yearly salary is £30,000. Given this information, their monthly salary is £2,500, so we simply need to multiply this by number of years to calculate the lump sum amount. In this case, 2,500 times 15 would give the employee a redundancy payment of £37,500. This is their contractual redundancy pay. Now, the first £30,000 would be tax-free, as we've already discussed. However, anything above that would be taxable as income. How much tax would depend on time of the year and what pay threshold the employee is pushed into. Let's say worst case is 20% taxed on income. The total take-home sum would be £36,000. This is far more generous than the UK statutory amount, which in this case would be £12,980. Now, the NHS is by no means perfect, but this package shows the power of its redundancy scheme. It's worth noting that in cases like this, employees can often have the option to take their pension early. NHS redundancy can affect your pension options, especially if you're considering early retirement. First of all, it is worth noting that NHS redundancy will not affect your state pension benefits, although if it leads to gaps in work, you might have missing NI years, which could affect state pension amounts. If you're an NHS employee and a member of the NHS pension scheme, on the date you're made redundant, your occupational pension options can change. In some cases, you can access your NHS pension immediately, rather than waiting until your normal pension age. This is often called redundancy early retirement. To be eligible for pension-related redundancy benefits, you generally must be an active member of the NHS pension scheme at the time your contract ends, have at least 2 years qualifying membership in the NHS pension scheme, and 2 years continuous service verified by your employer. You must also have reached your minimum pension age, which is usually 55, but can be 50, with protected rights for some old members, and you cannot have unreasonably refused suitable alternative employment in the NHS. If any of these aren't met, you cannot access early pension options on the grounds of redundancy. Once you meet the eligibility criteria, you normally have multiple options. Option A, defer your pension. In this case, you take your redundancy payment and leave your pension in the scheme deferred, meaning it stays there until you retire and claim it later. Option B, take early retirement with a reduced pension. With this option, you can choose to draw your NHS pension early at a reduced rate because you're before your normal pension age. This doesn't affect your redundancy payment. Option C, retire on grounds of redundancy and use the redundancy payment to buy out reductions. Now, this is a big one. If you want your pension early and unreduced, you can use your redundancy payment to fund it. This process is called the capitalization cost. This cost is based on the difference between unreduced pension and reduced pension, plus the cost of paying any lump sum early. If your redundancy payment is enough to cover the capitalization cost, you can pay that cost and keep any leftover cash. If it's not enough, you can choose to either take a partially reduced pension or make it up with added personal contributions to buy out more of the reduction. It's important to get advice here, because the timing and method of pension access can make a significant financial difference. NHS redundancy isn't just an ending, it's an asset. Used well, it can give you time, options, and control over your next move, including how and when you access your pension. With the right information, redundancy can be a strategic reset rather than a setback, and understanding the rules is what turns it into an opportunity. Thank you for watching. If you found this video useful, then feel free to check out some of my other 10-minute explainers. Please hit the like button below on the way out, and subscribe for more simple finance videos covering pay, pensions, tax, and long-term wealth. I hope we cross paths again, and I wish you all the best for your future.